In this video, I'm trying to answer the question, what type of strategy exactly is trend trading or trend following? In the words of Michael Covell, he summed it up really well when he said, trend followers use reactive technical analysis. Instead of trying to predict a market direction, their strategy is to react to the market's movements whenever they occur. This enables them to focus on the market's actual moves and not get emotionally involved with trying to predict direction or duration. A trend follower isn't trying to predict where a market's going to go. They're trying to, in real time, make buy decisions based on the direction of the trend already in place or beginning. The goal of a trend trader is to capture the trend in a market for profits. So if their signal is a 200-day moving average, they're looking at the long side over the 200-day moving average. If they're trading intermediate term, they're looking at buying, staying long above the 50-day moving average. Others, to filter out a lot of the noise, they'll take moving average crossovers. If the 10-day crosses over the 50-day, then they would get long and hold until the cross under happens. So this gives them reactive reasons to enter and exit positions and not just randomly try to choose what they think is going to happen next, which is virtually impossible. Trend traders use signals to enter and exit their trades in place of opinions, predictions, and feelings. So they are changing the motivation for entries and exits from trying to prove they're right to just trying to follow what the market's actually doing. Backtesting is a major tool for trend followers. By seeing what worked in the past, they have better odds of signals for the future. A backtest can be used to see what actually happened. This example is a 200-day moving average and how it did hold and signal an uptrend in the market. Recently, last week, we did have a drop below the 200-day moving average, but it is back over it as of Friday. So historically, the backtests, just trading above the 200-day moving average, returned 167%, while buy and hold returned 132%, and the drawdown with a trend following 200-day moving average, something this simple, beat the buy and hold drawdown by 50% less drawdown. So something as simple as a 200-day moving average can beat buy and hold. So this is a tool they use. This is just an example with a 200-day, but they can backtest all kinds of different signals with breakouts and how long an equity has made an all-time high and how far it goes on average, and using the crossover systems that we talked about and different signals to trade trends. But the big wins and small losses is what really makes the trend trading systems profitable, not high winning percentages. They could be wrong over and over, buying a 200-day moving average break. Be wrong and they'd be wrong and then have a big win. They can be wrong and chopped up a few times and then have a huge win, depending on what their signal actually is. The way they are profitable is really because their wins are big and their losses are small. They can use moving averages or breakouts in price for entry signals, so they're not stuck with they're all different trend traders and trend followers have different signals for entering trades. They use trailing stop losses to let a winning trade run for as long as possible. If they entered way back on the 200-day moving average breakout on this chart, they wouldn't exit till it broke under. Then they'd get back in if it broke back over. The 50-day, if they exited with the 50-day break, then they'd get back in when it went back over and stay long until it lost it. So, their entries and exits, this is just an example, but they have entries that get them in that are quantified, and then exits that get them out that are quantified. So they're looking for a big win when the trends do take place. They use stop losses after entries to keep their losing trades small. So if they say they're going to get it on a crossover and then then it crosses back under, then they get out. If you have a crossover gets you in, then the cross under gets you out. So it depends on when the crossover. If it's a trend, the cross under happens much after the crossover happens. They do not try to buy the bottom or sell the top. They just try to capture a large part of the trend. If they're getting in, they're not trying to nail getting in right at the bottom of a market. They're just trying to get in when the price breaks over the 200-day moving average, and they're not trying to exit at the top. They're just trying to, exit when the long-term uptrend or whatever trend they're trading has ended. They're trying to get out, so they're just trying to capture a big move in scale to their losses. They're not trying to be perfect. They're just trying to have big wins and small losses. They do not try to predict what will happen. They trade based on what is happening. They're not trying to predict a crash here. If it keeps going up, they're going to get long, and they're not going to try to predict a crash. They're going to keep going with the trend. People can start calling a crash back here and miss this entire trend. A trend trader will have signals that gets them into a trend and stays long until a big plunge or drop does happen, and then they will have a signal, whether it be a cross under of two moving averages, or a cross under of a key moving average, or a cross under of a long-term moving average. They will have a signal for getting out, but it won't be until after the trend is over. They won't get stopped out over here, for no reason. They will have a reason when they finally do get out of a trend. The key to a trend trader's profitability is the asymmetric nature of their trading. Their downside is managed through position size and tight stop losses, but their upside profits are left open during a trend until they have a good reason to exit a trade. The whole reason they're profitable is because when they're wrong, their losses are small. When they're right, their profits are big. When they're wrong, they have small losses. When they're right, they could catch an entire trend of this magnitude. So that's really what causes them to be profitable. They don't bet their entire account on one trade either. Each trade is position size based on the volatility and the potential risk of loss. They're not out gambling their entire account. One trade, this trade, if it was a QQQ trade, it might only be 10% of their account. And if a maximum plunge happens, they might lose 10% on the position, but only be down 1% their trading capital. So that's the main reason they win is the big wins, small losses. They can have small drawdowns, but then big growth in capital when they do catch the big uptrend. So I hope this helps you. This is what trend traders do. They try to stay on the right side of a market and have reactive technical signals for getting in and getting out of a trade.